All right, welcome to today's Explainer. We're kicking things off right away with some classic wisdom from Benjamin Graham. The market is a voting machine in the short term and a weighing machine in the long term. It's honestly the perfect quote to frame our analysis today, because it forces us to separate the noise of day-to-day price volatility from the actual underlying structural growth of a business.
So let's dive right in and evaluate if SoFi is actually evolving into a viable long-term investment or if it's just riding short-term market noise. We're going to look past the daily voting machine and really weigh the fundamentals of what this company is building. Here's our roadmap for the day. 1. Business model evolution. 2. Evaluating management strategy. 3. Financial performance analysis. 4. Assessing intrinsic value. 5. Market trends and catalysts. And 6. Elliott wave technical analysis.
Section 1. Business model evolution. From digital bank to infrastructure.
So the crucial point here is that this new structure gives them 3 distinct competitive advantages. It really distances them from your traditional fintech peers who lean way too hard on wholesale funding. First off, ecosystem lock-in. Their cross-sell rate has hit 43%. That means almost half of all new products are picked up by existing members. Second, look at that cost of funds advantage. A staggering 96% of their lending capital comes directly from deposits. That gives them a net interest margin of 5.94%, which is a massive buffer traditional fintechs just do not have. And third, because they literally see everything, from spending flows to investment holdings, they've got a huge informational edge for data-driven credit decisioning. Plus, they're already powering other institutions out there through their Galileo platform, managing over 128 million accounts globally. 14.7 million. That's their massive member count as of Q1 2026. And this isn't just sitting stagnant, it's up an incredible 35% year over year. As these millions of users get locked into the ecosystem, using multiple products from lending to deposits to crypto, their switching costs go way up over time.
Section 2. Evaluating management strategy. Discipline and foresight. Now, there is a massive strategic contrast happening right now in the space. While traditional banking is, incredibly cautious and hesitant about crypto, SoFi's management is looking years down the road. They aren't just putting out some digital token for the hype. They've integrated their nationally chartered SoFi US stablecoin right into the MasterCard global payment network. The goal isn't a quick brand gimmick. By enabling 24/7 real-time settlement for enterprises, they're laying the groundwork to completely compress traditional business hours and cross-border clearing times over the next 5 years. They're actually positioning themselves to reconstruct the underlying plumbing of global capital flows. Section 3. Financial performance analysis. Profitability and balance sheet. Their balance sheet offers an incredible margin of safety. We aren't talking about some highly leveraged institution here. They're a conservatively capitalized bank sitting on $3.4 billion in cash and a whopping $40.2 billion in total deposits, which, by the way, grew by $2.7 billion in a single quarter. Compare that to total debt of just $1.8 billion. On top of that, their tangible book value is sitting at $9.2 billion, or $7.21 per share. That's up 57% year over year. And you know what's even more impressive? For a company that just reported its 10th consecutive GAAP profitable quarter, with Q1 2026 net income surging 134% year over year to $167 million, the quality of that revenue is absolutely stellar. A massive 99% of their adjusted net revenue is high-quality, cash-based income coming from net interest and fees. They aren't relying on equity financing or sketchy one-time gains to pad the numbers. It really proves they've transitioned from that growth-at-all-costs mindset into a self-sustaining, cash-generating machine.
Section 4. Assessing intrinsic value. The weighing machine.
To figure out the intrinsic value, analysts often use what's called a 2-stage discounted cash flow model. For this analysis, the model applies a 10% discount rate and projects an $825 million free cash flow for 2026. From there, it models a growth phase tapering from 30% in 2027 down to 15% by 2030, eventually settling into a perpetual growth rate of 3.5%. Basically, it's a highly structured way to slap a current price tag on all that future cash generation. When you crunch those numbers, the total equity value comes out to roughly $24 billion. And the conservative estimate for intrinsic value? That lands precisely at $17.27 per share. What makes this so fascinating is that this intrinsic valuation sits intriguingly above the recent $15 to $16 trading range we've seen. And even if we stress test this with a sensitivity analysis, say tweaking growth or discount rates by a percentage point,
the value still holds incredibly firm between $15 and $22 per share. Section 5, Market Trends and Catalysts, Drivers and Risks.
All right, we're seeing some really clear growth drivers here. They are onboarding heavy-hitting enterprise banking clients, names like Galaxy, MasterCard, BitGo, and Wintermute. This brings in high-frequency transaction volume and serious deposit stickiness. Plus, on the consumer side, they just snagged the #1 spot in J.D. Power's 2026 U.S. Investor Satisfaction Study for DIY investors, completely outperforming the competition on digital channels and fee value. But as objective analysts, we've got to neutrally acknowledge the risks. SoFi is highly sensitive to the interest rate environment. Prolonged high rates from the Fed could absolutely contract personal loan demand. On top of that, they're operating within an evolving stablecoin and crypto regulatory framework, meaning any sudden policy shifts could impact their momentum.
Section 6, Elliott Wave Technical Analysis, the voting machine.
Looking at this through the lens of Elliott wave theory, we can clearly identify a 5-wave impulsive structure. We see a strong wave 1 rise, followed by a deep wave 2 correction that looks to have bottomed out right around that $15 mark. According to this technical setup, we're at a major inflection point right now. A powerful wave 3 is potentially initiating, and that targets the $48 level. For those managing risk, your stop-loss reference would be a break below that $15 wave 2 low. Meanwhile, the ultimate long-term completion of wave 5 could actually target the $60 to $65 up. And the underlying indicators? They're firmly backing up that wave theory. The relative strength index hit 37.61, skimming the oversold zone, and is now starting to curl upward. Couple that with a clear, recent surge in volume, and you've got a strong signal of actual capital inflow at these historically lower price levels. It really adds significant weight to the thesis that the bottom is finally in.
Let's bring this whole picture together. We've just analyzed a company that's seamlessly transitioning to GAAP profitability, holding an absolute fortress of a balance sheet, innovating with stablecoins on global payment rails, and currently trading below its calculated intrinsic value, all while showing a highly compelling technical setup. So as we wrap up this explainer, I'll leave you with this final thought to chew on for your 3 to 5 year investment horizon. Based on everything we've weighed today, is this merely a consumer app destined to fight for retail deposits, or are we literally looking at the foundational infrastructure of future global capital flows? Thanks so much for learning with me today, and keep weighing those fundamentals.